Welcome back to the Options Insider's exclusive coverage of the 2010 Options Industry Conference. Coming up next, we have the panel session entitled Adaptation, the Retail Marketplace. The moderator from this session is Kevin Murphy from Citigroup, and the panelists include Chris Larkin from E-Trade, Randy Frederick from Charles Schwab, Pete Bottini from Options Express, and John Dominic from Trade King. Thanks again for downloading this session, and be sure to stay tuned to the OptionsInsider.com and Options Insider Radio for more exclusive coverage of the 2010 Options Industry Conference.
The retail marketplace remains one of the most critical to our industry and one of the areas most impacted by the financial crisis. We're very pleased to have this panel here with us today, especially Kevin Murphy to moderate. We don't have an official count. This may be his 200th panel. He's quite the expert. He's been with Citigroup for quite some time. He's the managing director and head of U.S. Option Electronic Execution. Kevin has an extensive career in the industry spanning multiple business areas and asset classes, and we're grateful he could be with us today. Kevin, I turn it over to you.
Thank you, Boris. And we would like to, first of all, start by thanking the ISE for putting us on the last panel of the last day. It kind of brings new meaning to the word, saving the best for last, and hopefully that's what we have here. We'd also like to thank everybody in the audience for showing up. It shows your diligence in this in industry, and as a token of our appreciation, I have a white envelope here. It has a little smiley face. If everybody would lift up the tablecloth in front of you and look under your desk. Does anybody find a white envelope with a smiley face on it? You can look to the person next to you, look around for a white envelope with a smiley face on it. Everybody, a white envelope with a smiley face.
You might have to do hot and cold pretty soon.
Yeah. All right, well, I'm going to try that again a little bit later.
Sure, water.
We'll probably need a few more people. And if someone wants to kind of go around looking for a white envelope with a smiley face, let me tell you, you're going to want to find it.
All right. For Bear Stearns.
But while people may be looking, we're excited about the panel today. With us, to my left, we have Pete Bottini from Options Express. To his left, John Dominic from Trade King. Next to him, Randy Frederick from Charles Schwab. And last but not least, Chris Larkin from E-Trade. So I guess just to start, the term retail marketplace is often misconstrued because what people ordinarily think of as retail flow, very often it's very professional or institutional-like. And at the same time, what people traditionally characterize as institutional flow is also much more retail-like. It may be money managers hedging, portfolios with overwriting. So, starting with Pete, the topic of this panel is the retail marketplace. So, Pete, how do you define the retail marketplace?
Well, I think in trying to keep it simple for us, the retail investor is somebody that is basically making their own investment decisions and managing their own money, whether that account that they have managing is a corporate account, a joint account, an individual account, or a retirement account. It's basically the investor that's basically taking the decision process into their own hands. For us at Options Express, we have a lot of retail options investors, and as you know, Kevin, the retail options investor adds a layer of sophistication and education, an even stronger desire to educate themselves, and definitely seen in the last couple of years an adaptability to different markets and a desire to learn about new products and new strategies to take advantage of different market scenarios.
Yeah, I think just to add on from what Pete said is we've also, as you talk about this, and I agree, it's a self-directed customer. And one of the things that we've been that I think all of us have been catering is that there has been a meaningful flow of individual investors from the full-service firms coming into the online brokerage space, and a willingness to learn. Where back in the days when a couple years ago when the market was getting beaten up, they felt they lost a lot of trust in their broker that they weren't there to protect them, and so they wanted to take their own investment in their own hands. So as we've come in here, they've not only getting these customers in and willing to learn, they want to learn how to protect themselves. And options is a great conversation to start stuff like that.
Yeah, anybody else? Or? All right, but I think, maybe moving to Randy, the retail investors seem to have embraced options a lot earlier than the traditional money manager. Is that starting to shift now? Or?
I think it finally is, actually, believe it or not. I've really only seen the shift happening really in about the last year and a half, possibly. I think trying to get a independent money manager to use options is kind of like getting a doctor to take his files off of paper. It's just tough to do. Really, within just the last couple of years, I've been asked, and I've been spending a lot of time doing educational events for our independent money managers and our Schwab Private Client Group. I've worked a lot with that as well. So it's a good thing because it's an enormous untapped or largely untapped segment of the market that now presents a lot of opportunity for us. So yeah, it is shifting, but it's a very slow shift, but it is certainly finally starting to happen. So I'm pretty excited about that, in fact.
Okay. Anybody else? Any other comments?
I think the opportunity is front and center, and it evolves around the fact that the institutional segment of the marketplace has the same needs as the retail. So they're definitely looking to the brokerages and looking to the industry for education as the hook to get them in to start using options in their strategies. So we have the infrastructure. I think in every panel that we've had, people have been talking about growing the pie, and the easiest way or the shortest path is through education.
Okay, very good. Well, maybe, John, if more money managers start using options, does that mean that retail usage has peaked, or?
I don't think so, not at all. I think we're still in a strong growth phase of retail use of options. To Chris's point, we've seen a big migration of a new group of customers who are coming out of the larger firms, and they come with a certain level of sophistication, and they're looking for returns above what you would normally expect, and these people are putting large sums of money to work, and they're using options to do it, and they're using options to generate income, they're using options to hedge. So I think we're going to continue to see this trend in the retail community, absolutely.
Yeah, just from E-Trade's perspective, and it's probably the same if you look at Schwab and Ameritrade and firms like that, the opportunity just within our own firms is quite tremendous. We still have a very low percentage of customers who are enabled for options, and then you've got a little bit smaller piece of the customers who are actually trading the options. So even as we compete amongst one another for the customers that are out there, we don't really need to beat one another up. We've got such an opportunity within our world to grow the particular business. And as you look at how the retail business has been growing, last year E-Trade set a record in the volume that we did. We outgrew the pace of the industry last year, and then this year we're actually doing more volume than we did last year. So we continue to see the trends that say it's moving up, but even within what we're seeing here, just from the current volume that we have, there's still a tremendous opportunity just within our own customer base, within the 2.6 million customers that we have, to teach these customers about the products. I think there's tons of opportunity out there for retail.
Yeah, I completely agree. The demand for the educational content that we provide is staggering, and I'm in the process of actually adding a person to my staff specifically to meet that demand because it's so huge. And as you said, we're focusing primarily on our internal clients because they do represent a fairly small percentage of our overall client base, but it's pretty phenomenal, and it's a great thing for all of us really to see that. Certainly some of it comes from outside, but the vast majority of it comes from inside.
Okay. Well, digging a little deeper, maybe, Chris, how are retail investors using options, and what are they expecting from you?
Well, first of all, they have high expectations of what we have to do. Our customers are very demanding overall, but the customers, number one, is they're using options. Today they use options, from our standpoint, is speculation and for income generation, especially in this low-income environment. We've seen a lot of customers, the increasing use of covered calls. But it's not really important to look at sort of where we are today. It's where we've been and where we're going, where I think when options, if you look back, 7 or 8 years ago, it was purely a speculative tool. We're now seeing customers to shift in the trends in the right direction, start using it for hedging, for income generation, and even our spread business to do more conservative strategies like, whether it be a debit call spread or whatnot. that part of the business is growing much faster than our traditional business. So I think a big part of that is education. So you talk about the demand of what our customers want. And Randy's saying as well, the education is one of the biggest things that they want. Even there was an OIC, I think they mentioned about the OIC survey that just came out that they do every 5 years, the Harris survey. And there's been, the one change was, like if you want to trade options, why are you not trading them today? And the answer always used to be that they're too risky. This is the first time that we've seen customers are saying it's because we just don't know what they are and how to use them. And then they're too risky actually fell behind that actual answer. That's a big thing where customers now are starting to get past the perception that these are a risky product. And so from an education standpoint, there's a tremendous thing. And then service, like as you kind of go up the spectrum, you're trying to cater to the education, which goes from the beginner investors all the way up to the most sophisticated investors are looking for education. We need to deliver on that part, but even the service standpoint. So our high-end option traders demand quality service when it comes to options. And I think, again, 7 or 8 years ago, you would call up a rep at E-Trade and someone would mention the word, butterfly, and they would be running around for 8 managers to find out even what that is. We've had to educate our entire customer service teams, and now we have a dedicated team with people that have been working on the floor for, on average, 20 years to handle our most highest-end users out there. So they're demanding. You just got to be able to cater to all of them in the different things they want. But I say education is by far the number one. And then, again, tools and things like that are obviously extremely important.
I think Chris's comment about that these clients are using for income and hedging generation is pretty key. And in fact, the survey that we did just recently at an event just a couple of months ago, among our active investors that are using options, which is a pretty high percentage, 74% of them were using options almost exclusively for hedging and income generation. That number is substantially higher than what you would have seen just a couple of years ago. As Chris said, it would have been more of a speculation vehicle. That shift is a very encouraging thing for us because as they use options for the proper reason, they become sustainable customers, they become profitable customers, and of course when they are profitable, we're profitable and everybody wins. So it's a great evolution to see that in our industry, I think.
Good. Anybody else? Or?
I think the time when a retail investor was buying lottery tickets and buying out of the money options has passed, and we're definitely seeing embracing more conservative strategies and having a more robust approach to a diversified portfolio with different things within that portfolio, whether it's credit spreads on indexes or covered right strategy, or right now again responding to the current marketplace. We've had a good run up. A lot of clients that either bought stock, were lucky enough to buy stock at the low end, or were able to make a lot back from what they lost from the sell-off in 07 and 08, are embracing a replacement strategy. They've learned enough to realize they don't want to go through it again. They're selling their stocks and they're buying some longer-term in-the-money calls. So the retail marketplace, again, they're using options for the right reasons, and that's a good story, and we have to tell it out there to the 90% of the online investors that don't use options today.
Okay, very good. Well, moving on to, let's say, market structure issues and, let's say, their impact on the retail customers. The SEC has consistently expressed their desire to kind of protect the long-term investor, and many of their proposals have, let's say, had that goal in mind. Maybe, Pete, if you want to start, assuming that the long-term investor is the same as the retail investor, do you think that many of these proposals, such as their proposal to eliminate flash orders and options, is that truly protecting the retail investor?
Well, Ed, rather than take the bait and go on my usual discussion about the SEC, over time in the option space, the SEC has been engaged and involved and done several things that have improved the experience and made it possible for us to thrive in this industry. And one of the first things they did was force multiple listing in the late 90s, which forced a nice career change for myself as I left the floor of the SIBO and got more on the customer side of the business. They also, in 2000, approved the first exchange that they had approved in 27 years, which was the ISE, and that was revolutionary. It forced all the exchanges to change their approach to technology. It afforded the opportunity for multiple liquidity providers to stream quotes into one engine and one quote consolidation. It tightened the markets. It provided an amazing amount of transparency and liquidity And I've always said that the best advertisement for our industry is the quote that you see on the screen. And they have, constantly been touching the marketplace and weighing in on issues such as trade-throughs and best execution. And so I think the SEC has traditionally done a good job in representing the long-term investor. That being said, the discussion about flash orders is a very, as we know from previous panels, a very politicized issue, not very well understood. There's not a clear definition of flash, but I anticipate with the market fee caps that they might ban certain types of flash orders. But I think that the type of order where a customer order can go to an exchange, be guaranteed MBBO or better, that order type and that process will still survive.
Anybody else want to touch that?
Yeah, I'll jump on that one. It's hard to know exactly how this whole flash order thing is going to actually come out in the end. But I will say that from a customer's perspective, anytime they see an order, whether real or perceived, that they get filled at a price better than what they were expecting, that's always a positive thing from the retail client standpoint. They're thrilled by that. And whatever percentage that might be, that's always a good thing. How this flash order is going to affect that, I think it's a little bit early to know for sure. But clearly, penny pricing has helped the average retail guy because it's tightened up the spread. Price improvement has been, by and large, a very positive thing for clients when they, again, whether it's real or perceived, if they think they're getting a fair price, because ultimately that's what everyone wants, that's a good thing. So I think it's a little preliminary to really know how this is all going to shake out exactly.
I think further to that, the speed and the consistency of the execution is really what's key to the retail customer. Like Pete said, if you see a quote, they want to be able to place a trade, get that order executed. And the mechanics of that just have to work. And they have to work consistently, and they need to work efficiently. And as long as those things are happening, whatever the mandates are and whatever the SEC is going to look into can't hinge on that. I mean, the retail customer that we deal with at Trade King is extremely happy with the executions that they receive and the prices that they get their fills at. So,
yeah, I think there's also an economic issue to the whole matter for the retail customer, and where we traditionally can access prices or quotes at an exchange that does not charge us, or we actually get payment back in some cases, to a model where our customers are generally takers. We have to access the market where we're going to increase our fees. It does have an impact on how we reinvest to our customers. We're spending a lot of money on our customers' education, tools, things like that. So it's important that we can access the best markets at the most efficient price. So there's still fee caps or no fee caps. It's still a fee, and one that if we can avoid it, it's much more beneficial to us and our customers, because that's the money we reinvest back into our programs for the customers.
Okay. Well, staying on market structure, and kind of not to beat a dead horse, but penny pricing. Let's say for Chris, is this really good or bad for the retail investor? How it has evolved?
I kind of wear two hats on this issue. One is that it clearly has been beneficial to the customers. I mean, I think spreads have tightened out there. I think it's been clear on those names, especially on the high volume names. You've definitely seen the benefit from the customers. Certainly, it's had an impact on the payments to the firms like us, which is less of an issue for us than maybe some of the smaller firms that are out there. But the other hat that I wear is it really good for the overall industry? So as I think about different issues, and if you ever want to make a comment, sometimes what's great for the retail investor might not be so good for the overall industry. And I think what's to be determined is what is the overall impact? I mean, there's clearly been an impact on market makers with pennies. And is it good that the customer in the short term gets a tight spread where we're putting all the market makers out of business, and then in the long run spreads widen, or if they want to go out and get quotes on leaps and whatnot, they're getting $5 spreads that are out there. So I think the big TBD is that I think it's been good for the retail customer short term. But in the end run, if we look down here 5 years from now, I'm not 100% sure it's going to be the best thing for our industry. I think it's still TBD right now.
Anybody else?
That's a big concern, because while we still think there's a lot of opportunity to grow the retail space, we think the big driver in volume growth is going to be the institutional space, and they have different liquidity needs. And right now, in most of the penny names, our customers trading their 15 or 20 lots, they're getting executed at MEBO. We're very nervous when we see quotes in the marketplace that have 2 lots or 3 lots on the bid ask, because that gives a false sense of the price to our customers. I'm also concerned about these new entrants into the marketplace and how they're going to access liquidity. Now, because of who controls a lot of the institutions, what we could see is some of the dark pool ideas that have been floated around the options space for the last 4 or 5 years has really started to take hold, as these institutions are going to need creative solutions to finding liquidity because their needs are not going to be met at MBBO.
I hear you. Well, the new short sale rules do not provide for a market maker exemption. And, clearly that seems to prevent the naked short sellers from simply moving to the options market when the circuit breakers are reached. But, maybe, Randy, if you want to comment, is that, how does that really affect the average option user?
By and large, I don't think the average option user really understands that at all and sees it. So if it's affecting them, they may not even realize it. And I think, it's another one of those things, I hate to say this, but it's preliminary. It's a little too early to kind of know exactly how that's all going to shake out. I don't think the average option user wants it to be simple. They want to see a quote. Like Pete said, if they're doing a 20 lot, they want to be able to get the 20 lot at the NBBO, and that's it. And by and large, most of them are getting that. If it ends up having an impact on them, it's likely they won't even know that that's what's causing it. And again, I don't know that we even know how it's going to come out. I wish I had a better answer, but I just don't think we know the answer to that one just yet.
I take it, so if the stock's down 10%, option quotes wide, that's probably going to be either normal or accepted for them?
No, it won't be normal or accepted. It'll be a bad experience if quotes go wide. We don't know that, as Randy said. I do know that the day after the emergency order in October of 2008, it was not a good experience for retail investors. A lot of retail investors lost a lot of confidence in the marketplace. And with the exception of that one Friday, the listed space has done real well throughout the volatility and throughout the crisis. I don't know that story is told loudly enough, and the regulators and politicians seem to be very focused on a listed space and less focused on the OTC space. But one of the comments that Jamie made yesterday that I didn't know, maybe I caught it wrong, but I thought I heard him say not granting the market maker exemption in the option marketplace when they tripped the circuit breaker was not an issue because most option market makers, or most market makers, hedge by selling on the offer. And that kind of piqued my interest because I'm always concerned about regulators that don't quite understand how the marketplace functions. Yeah. And maybe
or politicians either.
Or Schumer after he gets his check, yeah. But the knowledge of the regulators and the knowledge of the politicians influencing the structure of the marketplace is not a good thing. Now, the fact that the SEC took all the proposals and kind of went down the road of probably the least impactful proposal, it will probably not impact our marketplace too much.
Well, with the market fragmentation that we've seen, and we've heard other panels, commenting on it, that it's harder and harder to access all of the markets. There's smart order routers out there. Some firms decide to route their own flow to all the different exchanges, pay all the exchange membership fees, etc. Others use, aggregators, to use their smart order routers. I don't know, Chris, you're going to start with who's, what is the role of the, let's call them the option consolidators?
Well, first of all, so E-Trade utilizes the consolidators out there, and we have for the last several years. I would say that the aggregators in the marketplace has probably been one of the best services that's come to E-Trade in a long time in terms of benefit, not only to us, but to retail customers as well. And the reason is, everything that's going on, you're looking at the competition that's happening out there, is everything is, in the end runs, benefiting the customers. So you've got the exchanges that are out there that are competing, and we've got ourselves competing from an online brokerage, tools, services, things like that. And now you got the consolidators that are coming in. They're competing against one another to aggregate some of the flow into their shop. And that's a beneficial thing back to our customers. And it was a great decision for us to go down that several years ago. And today, with everything that's happening in the marketplace, it releases such a heavy burden for us to not deal with all the things like the fees and trying to route things in different areas. They come back to us and they're routing it to the best place. We're beating them up on speed. We're trying to make sure we're going to the right markets and whatnot, but they're actually doing all the heavy lifting for us. And so we can redeploy those resources from us to do other things in our organization. So I think from a consolidator standpoint, it's been, at least from E-Trade standpoint, it's been a huge service for us. And probably like I said, the past 5 years, I can't think of another one that's been better for our customers.
Any other comments?
Yeah, more along the same line. It really allows us to focus on what we're good at Trade King, which is service, education, and taking care of the customer and dealing with the consolidator relationships and managing those relationships and making sure the quality execution is there, and allows us to focus on growing our business, which we continue to do.
I think that from our perspective, we take a little bit different approach. We try to maintain a balance between what we route directly to the exchanges, so we have an influence at the exchange level and manage the quality of the order flow and compare that back to what the consolidators are giving us. The consolidators do a great job because they realize efficiencies with their technology, and they also realize efficiencies with their cost, and they have the benefit. Most consolidators have the benefit of liquidity on some arm related to the broker-dealer. But that also introduces a conflict, and we try to keep that conflict on the up and up by managing some of the flow ourselves and making sure that the experience that we know we can manage for our customers, they live up to that experience.
Well, John, you mentioned focusing on things that you do right, and clearly education has played a major role in the growth of the options industry. What kind of things are you doing from the education side to help your customers?
Well, education is key in all forms. So we participate in a lot of the industry events such as OIC seminars. We sponsor those across the country. We have a team of educators that work within Trade King, and we have an area of our site dedicated to webinars. We have over 60 hours of webinars that customers can view at their convenience. We published a playbook called the Options Playbook. Brian Overby, who's been with us since 2005, broke down a lot of really good strategies page by page where customers can read these strategies, understand what type of option plays to put on, whether they're a bear, whether they're a bull, whether they think the market's going to go sideways. So there's a few different forms that we take. We have a trader network on our website, which allows customers to interact directly with each other and share trades, show other customers what they're doing. I can sign up to view and interact with you, Kevin. If you're a Trade King customer, I can set alerts so that when you make a trade, I'll get an email and I can log in and check out your portfolio, what kind of adjustments you're making. I mean, the customers are taking a very proactive approach to managing all of their resources that they have at their fingertips. And then service. Customer service is really something that we feel we're experts in, and handling all of the inquiries from basic customers all the way up to semi-pro, quasi-pro, heavy contract traders, and every customer touch is part of education. So it's something that we focus on, and it's something that we think we're doing really well at.
Yeah, I completely agree with John. Education's key, and I don't think there's really anyone in the room who would ever dispute that issue. The fact is, options are a lot more complicated than equities investing, and no matter what we do, that's always going to be the case. Mm-hmm. The key is you have to approach customers, as John said, in at every angle. We have an online community that has over 11,000 participants where they can communicate with each other, and it can be segmented by the type of investing they do, even so much as the type of option strategies that they use. We provide online content in the form of articles, webinars, self-paced tutorials, things like that. And again, we partnership with the OIC, with the SIBO, with just about everybody, and plus our own live events that we do, which are attended by 500, 600, 700 people. All day long seminars. They're not strictly options, but options is a key element of that. But the key is everyone learns differently. Everyone has a different approach, a different thing that works for them. Some people want to just read something on their own. Some people have to go to a live event and actually see a live person in front of them so they can ask questions and have a visual along with it. So you have to approach it from every perspective. And I think for the most part, we're probably all doing that to some degree. But clearly that's a key, and it's an area where we have to go. We have to somehow differentiate ourselves, and I think that is one of the ways we do that.
And just from some of it that we've done new, I mean, outside of the typical things we're seeing out there, we've just started a new 3-minute video series for our customers. And as we've gone out there, it's sort of that YouTube world out there that there's an attention span. In order to get a customer's attention on a particular product or service, you've got about 2 to 3 minutes of their time to catch their attention. So we've used that as a continuum where we start with customers to get them an interest in the product from a video standpoint from our 3-minute video series, and then try to transfer them into the more lengthy type of educational stuff. So it starts off at 3 minutes, you go to 10 minutes, and then you go to the hour. And then the customers feel a little more comfortable as they're going across that. So as we kind of see, we measure a lot of things that's happening out there in the world, especially from the video standpoint, because I think that one of the big reasons why education has exploded on our side is in order to deliver education, we've gone away from having to always have some type of a physical, go out and rent a hotel and get 50, 100, 200 people in a room, to now be able to reach many more customers out there. So the things like web seminars and videos or whatnot are allowing us to reach a ton more customers out there. And even from our Options for Beginner video series that we produced last year, it's a highly produced video, we had over 100,000 people that actually watched that video in full length last year. So that's a great way to reach a lot of customers, where in the past we had to go out and it was very much hand-to-hand combat out there. So that's been a big thing. Technology has been a big reason why education has been so successful in this market space.
Yeah, I think we're starting to evolve. The education effort in the industry is evolving to a customer lifecycle approach where, it used to be, you'd push a product, you'd talk about a certain strategy, and now we're all tracking the customer where they are in their investment lifecycle and making sure we have educational opportunities available to them based on where they are in that lifecycle.
And just one last thing, I know I've kind of talked about this before too, is that education, if you look, if you went back into sort of like the, early 2000s and whatnot, education at our firms generally was check the box. You just kind of had to have it because it made you look like you're protecting the investors. And that's really shifted where all of us are trying to partner with our customers. We want them to be successful. We've got a skin in the game as well. So we've gone from, check the box to investing a lot of money in education and trying to partner with our customers, because we want to go with them together and say, we want you to be successful, we'll be successful, but we got to be a partner with them. So that's been a big shift as well.
All right. Well, it's widely acknowledged that market makers are having, let's say, more challenging time making money in this low volatility marketplace with tighter spreads. If this starts to affect rebates and as maker-taker exchanges continue to, let's just say, gain some traction, how will this impact retail commissions and your ability to provide things like education that you do that maybe retail investors take for granted? So I don't know, Chris, you want to?
Yeah, I think that when it comes down to sort of the payment for order flow, I've always felt it's had really it's been a misperceived thing that's out there. E-Trade is not like the Pittsburgh Pirates where, we get revenue sharing and we put it in our pocket and, we move on. We have invested in everything from the retail experience. Our commissions, have dropped from $2.50 a contract down to 75 cents a contract. We've improved our tools. We're delivering education. We've taken all of that money and that gets fully invested back into our customers out there. So it's not like we're just pocketing the money out there. And I think it's, for E-Trade, payment for order flow is it's a relatively small line item for us, so it's not a major impact for us. But it's more of an impact, I think, for some of the boutique firms out there. But we welcome the boutique firms that are out there because the competition is good for all of us. It's made us improve. I mean, Pete, Options Express is a firm that has had tremendous success out there, and it really woke up some of the big players like us out there about delivering a much better options experience there. We need some of the small boutique firms to continue to push some of the firms like us that are out there. So I think it's still an important part. The fee thing is, as you look at the maker-taker things and stuff like that, our biggest worry is the options industry becoming like the airline industry, where we're just getting feed for everything. So it's not just the maker-taker, it's the ORF fee, it's this fee, it's that fee. And we don't want to go to a model where we've got a commission, but then we've got the small disclaimer that we're passing along this fee, that fee, and the other fee. So I worry about not just what's in place today, but what's coming with the other fees that might be out there in the marketplace. That's our biggest one.
Yeah, I think it's key. Transparency is key, and I mean that term has come up on almost all the panels we've had. Clients want simplicity. That's what they want more than anything else. They want to know when they enter the order how much they're going to be charged, and they want to see that amount be charged at the end. So if we start throwing all these little fees in the back end, it's not going to be a good experience. Ultimately, they'll eventually accept it and they'll deal with it because they have in every other way. But the reality is we work in a marketplace where we don't have the ability to raise costs. Commissions for the 22 years I've been in the business have done nothing but come down or stay sideways. I don't see us really being in a position where we're ever going to raise them. Fees, of course, if they come in and we can pass them through, we will, but it won't be a good experience for the clients initially. But it's kind of one of those things. I mean, we talked about all the benefits that the customers have had from tightened spreads, from price improvement. All of those things have helped customers do better, even the technology, the speed of execution, and all those things. And ultimately, these fees will end up just being the price that they're paying now for all of those benefits that they got. But that's still a very difficult thing to try to sell to people. They're not going to like it. Ultimately, again, if it's there and it's imposed, they'll deal with it. I don't think equity investors like the SEC fee either, but it's been there forever and they've been dealing with it, and that's kind of how it goes, unfortunately. But it is a bad thing. I don't like the non-transparency of that when people can't see it and they aren't aware of it and they don't know what it is. They just want simplicity. They want a fee that they know what it is up front, and then they want to see that charge. So.
Well, clearly, the exchanges are going to be thinking about this more and more as, with the cap on access fees, and customers have always traded free, and at some point do customers get charged? And so from the same thing from your perspective as, maybe as your, revenues change, but bottom line, you don't think commissions don't go up, huh? They just always go down?
Commissions can never go up. They only go down or sideways.
That's right.
Yeah.
I mean, we have to become more efficient with our technology. We have to figure out ways to maintain our margins through improvements in efficiency overall in order to do that. I mean, the cost, our overall fixed costs to provide the service, to execute, all those things have all come down. So if we lose a little bit, then we got to make that up with efficiencies. But I just don't think that we're ever going to be able to be in a point where we can increase commissions. I just don't think that's going to happen.
Okay. Well, along those lines, let's say moving to the options exchanges for a second. As more exchanges adopt the maker-taker pricing structure, including the latest entrant BATS, what kind of impact has this had on the retail investor? And I don't know, Pete, if you want to.
None. You're at a conference like this, and we're all under the hood. We're talking specifics about market structure and fees and changes. And our job is to show the customer a quote, an MBBO quote. They access that quote. They have a great experience. They get charged the fee that they knew when they put the order in. That's the fee they're going to get charged. So we don't pass through the maker-taker fees. We don't want to introduce new fees to our clients. And again, their experience is they see one quote. They don't know that there's 8 options exchanges. They don't care that there's 8 options exchanges. They just want to see on the platform. They want to think about different strategies. They want to price them out. When they make a trading decision, they want to go bam, and they want to see that position in their account at that price. So the changes in the fees and the changes in the structure is not something that they want to concern themselves with.
And I think most of us give our customers a choice. If they want to route their orders to a particular exchange, they can do it. But in the end run, they don't. They vote with their fingers, and basically they're choosing the auto button on most of our systems out there. So they have the ability to go out and direct it to any exchange they want. But I think there's a lot of trust in us being able to execute that order at the best price out there. So they have the choice, but they don't use it.
Yeah, the smart routing is key. I mean, it's kind of like in the old days, a person driving a sports car would like to have a stick shift, but these days we've got automatic shifters that shift manually, automatic, and far faster than even a professional driver could ever do. It's the same sort of thing. It used to be a huge issue for the clients to be able to route the order to whatever exchange they want. A smart router can think and move infinitely faster. And as Pete said, whether there's 5 participants out there or 8, if the smart routers can split that order apart and make sure that the client gets filled at the best price, regardless of how many ways it goes, it really is irrelevant to the customer. Even if they can see it, for the most part, it's not even important for them to be able to do it themselves. They're typically going to disadvantage themselves if they do. The smart routers are so good now that's the way they all go.
If one of my clients wanted to trade in Citigroup on Monday, and they wanted to know how much it was going to cost, and I took out my sheet and took 20 minutes of his time explaining that all the different variables with the different exchanges and the fee structures with the maker-take, semi-maker-take, whether or not your 99 contracts are 100 contracts, whether or not you're between the market taking liquidity, whether or not you direct it to a certain specialist or not. They don't want to be bothered with that.
So on the lines of exchanges, I mean, are there any initiatives exchanges are doing that are beneficial to your customers? I know, Randy, didn't you see?
Well, I mean, all the things that are going on now are are beneficial for the most part. I mean, the competition, as we know, is good. The penny pricing, again, whether it's a long-term good, is, I think, yet to be determined. It's definitely a short-term good. When customers see tighter spreads, they like that. The auto routing, as we said, the smart order routing is definitely beneficial. Just the increased speed of execution, the increased reporting, pretty much everything that's going on overall has been beneficial. Again, with the exception of the things we're talking about that are potentially coming up now, an increase in fees, a decrease in transparency might be negative. But overall, the product innovation is good. The speeds increase, the technology, everything. I mean, for the most part, it's all been, as you said, the SEC's goal is to protect those retail investors out there, and by and large, that's happened, and it's been a good thing.
I think they've also, from the exchange stuff too, is they've, they've invested a lot in education as well. So we get a lot of their resources from an education perspective, and it's good to partner with them on those things. And it's also valuable for our customers to have a valued brand behind the education, because there's always skeptical customers. If we want to go out and teach education, they don't always think that we're going to be able to have their best interests at heart. So when we partner with exchanges, we can bring them in to do some of our investor education days. That's a big thing for us, just because most of them are trusted brands out there. So that's important for us. They spend a lot of money on education.
They've definitely increased the service levels. Their help desks are more efficient than ever. They have access to all types of information. They're getting in the business of providing real-time fee data so that you can keep track and maximize your routing. And they're also always looking at areas where there might be execution issues. I know the opens are always an issue. Baidu has earnings; it's up $86, and they're providing information real time back to the execution desks to make sure that client orders are not disadvantaged on the open when there might be a lack of liquidity. So, something that again furthers the customer experience, prevents them from having a bad experience, helps to continue to grow the pie.
Well, on the lines of execution, Jamie Brigigliano had some interesting comments yesterday, and one of them was on 605, because we know that the execution quality reports for the equity world have not applied. 606 has applied to options, not 605 reports. There was a number of things that at the time there wasn't consolidated MBBOs and things like that. I interpreted his comments yesterday that 605 is coming to the options world. So currently, we have each exchange, producing execution quality statistics. We have other third-party providers producing execution quality statistics. Firms producing their own. Number one, I guess, do you utilize the exchange execution quality statistics, and do you see this more of a trend coming down the road?
Yeah, I mean, we use the data. We have to. I mean, the data is a lot of data. We've got to massage the data and make it work. That's out there. There's a lot of raw data in there. But we welcome the transparency. We're all about transparency as well. We welcome having transparent on execution. We do it today for the equity side. We publicly display all the best execution statistics on that side. From the options side, we've been more than welcome to do that as well. We look at it internally just like we do with the equity side. And I think that you look at best execution. I mean, again, we're so competitive in this world. Execution used to be at the top end of customers' angst when it came down to their orders, and things have gotten so much better. I mean, our average order is executed in less than a second for our option customers. I mean, that's just unbelievable. So we don't really get complaints on execution, to be honest with you. I think we do. You sometimes get complaints, I think, on some of the complex orders that are out there, but in general, for the straight customers that are doing single leg orders, there's very little complaints that are coming out there from our customer side. So I think that it's good, and we welcome the transparency putting it out there. So. Yeah,
I think it all comes down to customer confidence. They have to be confident that the marketplace is fair, and we've heard a lot of discussion about that this week as well. They have to be confident that we have their best interest in mind, that we actually are routing to the best place, that they are getting instant executions, and that that they couldn't have gotten a better fill elsewhere. Even if it's a perceived notion that they're being disadvantaged, if we can do anything that will create more confidence to them, that's all the better. I mean, there's nothing negative about that, really.
And they don't take it for granted. I mean, the customer experience is one that is improving every day. And like Chris said, the rare case when we see a complex order that doesn't get an immediate execution at the natural, for example, that phone rings and that's the customer, and he wants to know at that point in time, he wants to know where that spread is. And then we'll get on the phone and quickly rectify the situation. and then you have a happy customer. That's what's important in retail.
Yeah, so what you've heard is that the exchange reports and the 605 stats are good for the monthly or quarterly review for your routing committees, but the real-time experience of the customer, your best execution is order by order and making sure that experience is up to par.
All right. Well, finally looking ahead, we're coming out of one of the, let's say, worst economic environments in history. How has this challenging environment, affected retail option usage?
I really think it's helped. I think from our side, it's really brought an awareness to a product because customers have started, the question of risk, first came to light just recently. And where customers felt diversification was the way to manage risk, they found out that doesn't necessarily work in all environments out there. So then customers are asking, saying, if that doesn't work, what are my other tools that I have out there at the arsenal to actually protect me from certain things? So the idea that we have a very versatile product that's out there that can be traded in any type of market environment, I think that's number one. So I think there's been a big opportunity. Like I said, we had a record year last year. We're on pace again this year to have a record year. When the Goldman news came out the past Friday, we had a record day. Those types of days and the volatility in the marketplace it's like a big advertisement for the options industry. So I think that it's actually been beneficial to bring the awareness of this product. This actual economic crisis has really done a great thing for options overall, I think.
Yeah, I agree with Chris. I think it's true. It has woken people up to that there are other tools out there to use to protect themselves. And the one thing that's consistent as we talk to our active investors, that they all tell us that they want to be in the market at all times. The last thing they want to do when the market gets crazy is sell everything and go into cash. They want to remain in the market, but they don't want to take 30 and 40% drawdowns like they did in 2008. So they want to know what tools are available out there to cut those losses to 5, 6, 8, 10% maybe. I think most of these active investors would have been thrilled to have walked away from 2008 with 10% or less losses. And we all know there are plenty of tools out there in our business that could have done that. This woke them up. And now they're saying, you know what, I need to go find out about this. Because especially those, it hasn't been that long since the internet blew up. And a lot of the people we're dealing with now will live through that one as well. And they know that even though things are a little better right now, and we may have a couple more years to go in this bull market, the next bubble's going to be there, the next downturn's going to come, and this time I'm going to be ready. So teach me how to use options to hedge myself in this scenario. Even if you don't know how things are going to go, you kind of get this feeling when the market starts to look a little shaky or a little strange, and it's been a very good thing. You can't wait till your house is on fire to buy insurance. You have to buy it when it's cheap ahead of time before you need it and be ready. So I think the vast majority of the people we're talking to haven't traded options before. They just want to learn the basic stuff. They want to learn how to protect themselves, and they're very open-minded. And as Chris said, they found out that diversification alone is not always going to do it.
Yeah, and in terms of growth, we continue to open accounts at a record pace. Our customers are trading 30 to 40% of our business is options, and they're also experimenting with the leveraged products. The leveraged ETFs also playing a big role, I think, in the growth at this stage of the game. So I think we'll see a continuation.
And who do you see as the biggest users of options going forward?
Going forward, Kevin, I think we're going to continue to see new adopters in the option market. I think we're going to continue to see customers who are more comfortable with certain option strategies continue to employ those strategies, like Chris mentioned earlier. And we're seeing people start requesting options trading privileges at a much earlier stage in their investment career. And we're very happy seeing that trend in our customer base. So I think it's going to be a continued trend in retail. I think people are going to begin using options earlier in their investment career. I had a hard time convincing my father to start selling covered calls on his GE position. But once I did, he's regularly now in his account selling calls. I don't think we'll ever get him to do anything else, but I think customers are going to start earlier and they're going to use them throughout their investment career.
Well, just, let's say right before we open up for questions, key drivers going forward. I know, Randy, you see any key drivers for the options industry going forward that'll enable us to continue this tremendous growth?
Well, we've all talked about education. I think that's key, and we've also talked about the potential opportunity out there in the money manager space, the financial advisory space. I mean, it's incredible how large that space is and how underutilized this product has been in that area. So that's absolutely key. But for the most part, I think we all agree the biggest part of the opportunity lies right within our own client base. We don't have to get new customers. We just have to open our existing customers up to this potential. So there are a lot of things that could drive this. I don't think that the opportunity going forward we're still just scratching the surface for the most part. At least that's from my perspective.
Right. Anybody else?
Yeah, I think that if we can get more products out there, I know it's tough to innovate in this space and whatnot, but I think the exchange has done a really good job of innovating new products. I mean, the IC's had the FX products, which have been them and the Phillips have had some very good FX products, and they're being adopted by our customers, and they're becoming more aware of currencies and things like that. SIBO with the VIX and things like that. So any kind of products that come out like that are always good for industry as well.
I think there's also the opportunity. You get some insurance companies that have over-the-counter exposure, get them to start trading a listed product and hedging the listing product, and showcase the benefits of the transparency and the central clearing. Get some long-only funds to use some collar strategies, some override strategies. And then you get the mainstream financial media talking about that and kind of piquing the interest, getting a broader audience to understand how effective and efficient our product is.
Okay. Well, just to let's say open it up to the audience for any questions, any topics. These guys said they're wide open for anything.
Nice.
Hi, I think the concept of options for protection is a great idea, particularly in this low-vol environment. Just had a chat with Alex Jacobs from the ISE yesterday, and he was mentioning how this premium harvesting phenomenon, selling puts, covered calls, iron condors, has really taken hold with individual investors. Is there any concern, we had a little interruption last week, but is there any concern about continued decline in vols at some point? It's not going to be such a great idea to be selling premium relative to the reward risk. I mean, right now, iron condors are very challenging strategy in terms of getting a good reward to risk ratio. And there are actually some premium buying strategies like in the money strangles where you can limit your risk to perhaps 10, 15, 20% by being protected on the call, by owning calls and puts over a certain interval with some very significant profit potential because of the very low vol. So just an idea in terms of is there no vol level below which we're not going to be, we might be unhappy with how much premium selling is going on?
Well, just wanted to point out, thanks, Bernie, for being probably one of the first educators in the industry talking about our product. I was familiar with you as a market maker, and early with Options Express, we were able to partner, and Bernie has always been an advocate for the industry, for the product, and a sensible use of capital. If you're going to invest in a long stock, there's other opportunities to do it through options, and kind of told a very good story over his career. We do have concerns. We've had a lot of clients that are selling out of the money, either whether it's a condor or selling a call spread or put spread. The Russell and SPX tend to be popular products. And what we found is as the vols move down, the premiums are getting tighter and tighter, and they're moving closer and closer, which, again, as Bernie alluded to, they're taking more and more risk. And it's a fine line as a broker. We struggle with telling clients, hey, you've reached a point where your risk reward is a little out of whack. Why don't you look at X, Y, and Z? And what we try to do as educators is try to showcase some of those types of strategies to investors, knowing that they're kind of in love with the returns they've been seeing from the Russell and from the SPX strategies. So it's a subtle line. We can't tell them no. They're self-directed. They manage their own money. But we try to influence them in other ways. And I think the easiest way for us to influence them is to really hit them with a new strategy and explain to them why it works better in a low vol environment. Not exactly what you were talking about, but the stock replacement strategy is a great strategy now with the VIX in the teens. Why are you long? Why are you long U.S. steel when it went from 20 to 67? Why are you long when you can buy the 50 call for $17 and take some of that risk off the table?
From an individual equity perspective, there is a threshold, clearly. But the good thing is, because of the cost of executions, the cost of commissions have all come down, that threshold's a lot lower than it used to be. It used to be you couldn't sell an option at a dime and cover your commissions. Now you can, by and large. But you also have the ability now through really sophisticated screeners like the one we have, where you simply go out there and you set your thresholds. You say, hey, I'm looking for buy rights that have this threshold where I make this much, and it ignores the rest of them. I mean, yeah, it's tough to do buy rights on really low vol names like Procter & Gamble and Johnson & Johnson and Altria and these kind of names. It's very tough. But those might be the type where it's better to now look at an opportunity where, hey, but that means buying is really cheap. So for the entire market, if you're talking about, Pete, sure, there are going to be times where it's going to be so low that it's not worth the risk, but there will always be individual names out there that have higher vols, and screeners will allow you to find those opportunities a whole lot easier than you used to. So, I mean, that's where we're still steering people. Say, hey, here's a screener, this is still a good strategy. Just set your threshold and only look at the ones that meet those criteria without ridiculous risk. So that makes it a lot easier now than it used to be.
And I think the other thing is that the customer interest is still there. So they're using the tools, they're evaluating strategies. They're not, we can't control the VIX, but we're not losing the customer's focus. So they're hanging in there, they're looking for their spots, they're being patient. And I think I mentioned it before, we're seeing a little bit of a migration into those leveraged ETFs, which customers are also using as a form of a derivative product to take advantage of the moves when they do come. So I think, even though the VIX, I don't think we're too worried about losing those customers' focus. They're staying engaged. They're using the tools. They're evaluating what the risk and reward is, and they're taking action.
Any other questions? I think we have one back there.
Yeah, my question is for the moderator. I was just wondering if I might be able to claim the smiley face and whatever the prize is, since no one's found it yet.
Well, that's a good point. As far as if you were not here at the beginning of the panel, underneath your tablecloth there is a white envelope. You can, if you find it, you can either keep it yourself or you can give it to Chris Nagy as a charitable donation. But once again, you might want to look underneath your tablecloth. Any other questions from the audience for our panel? I think we have one in the back there.
Where is the envelope?
Well, we got some interest from the audience. Any option-related or industry-related questions for the panel? Okay, well, thank you again for attending, and I'd like to thank the audience. The audience and the panel. I'm sorry about that.
Thank you.
And that's going to do it for this episode of Options Insider Radio. Be sure to visit www.theoptionsinsider.com for more episodes of this program, as well as breaking news from the options market, the latest articles and analysis from options experts, a wide variety of options education, and of course our discussion center where you can share your questions, comments, and insights with your fellow Options Insider users. While you're there, be sure to register for our monthly email newsletter, as well as our free email alert system. Our email alert system makes it even easier to stay up to date on the latest content from theoptionsinsider.com. Thanks again for listening. My name is Mark Longo, and I'll see you next time on Options Insider Radio.
Options Insider Radio was created by Mark Longo and produced by Gene Crotty. Options Insider Radio is a production of the Options Insider Incorporated, all rights reserved.